Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
People like to say that there's a silver lining in everything bad that happens, and this is a great example of that. The first time that my guest Tony Lopes of Dirty Boots Capital considered real estate is when he got laid off of his regular W-2 job. Now, Dirty Boots is really important because it goes back to how Tony grew up, and this is why his company is named this. The name Dirty Boots came because his father worked construction full-time while managing his real estate investments on the side, and when he came home, his mother would kindly remind him to take off his dirty boots. This is an episode with Tony Lopes of Dirty Boots Capital. It's about the journey and it's about the end goal, a life of freedom. Let's go. This is episode 158 of Zen and the Art of Real Estate Investing with my guest, Tony Lopes. Tony is the CEO of Dirty Boots Capital, the author of Freedom at Risk, and a real estate investor, consultant professional, and macroeconomic enthusiast. Tony, welcome to the show.
Jonathan, thank you so much for having me on. This is going to be a lot of fun. Looking forward to it.
Yeah, me too. And if the listeners see that we have some rapport, it's because I've already recorded an episode of your podcast, which is going to come out soon.
Yes.
So we're old pros at this, but I'm glad to get you on this side. And I want to start here because we didn't talk about it on my episode with you. But when was the first time that you remember being interested in real estate?
So it was when I got laid off. Really is when it all started, which sounds pretty bad, pretty gloomy. But I'm probably like a lot of your listeners out there, where maybe came from immigrant parents. My parents were immigrants. Yeah. A lot of first generation and even second generation folks. We get the mantra from our parents, right, who are trying to help us along the way, and they say, the mantra is go to school, get a good education, get a good job, and you'll be taken care of for the rest of your life, right?
Work the 9 to 5, get the 401k, never look back, get a little small house with a picket fence, and don't do anything else, right?
Right. I mean, it's a pretty familiar mantra that we all live by, and so I followed that, right? I was a young guy. Sure, mom and dad are trying to help me out. So I went to school, got a good education. Actually, got 2 degrees, a mechanical engineering degree and a MBA, right? I had 2 great degrees from great schools. And then I got a great job. And then 4 years later, I got laid off. And I was like, wait a minute. This wasn't part of the mantra. Where was,
I thought I'd just stay at the company for 40 years, keep getting small bonuses, and then I'm happy, right?
Right. So that's really where, to jump to the chase, where real estate really came into play for me, because I took that as really an inflection point in my life to say, I don't really want to rely on just a sole source of income, being my W-2 job. And I'm not here to poo-poo W-2 jobs. That's not what I'm here to do. It served me well. And there's a lot of benefits. If you're a new investor, there are a lot of benefits to having a W-2 job. So I'm not here to kick anybody in the teeth for having a W-2, because there's benefits there. But for me, I looked at it and I said, hey, what do I do now? I wasn't financially independent, Jonathan, as you can imagine, right? I was paying my bills and whatnot. And so when I did land another job 3 months after being laid off, by the way, I had a lot of time to think. It wasn't like the economy we have now, where it's super strong economy, very low unemployment rate. If you were to leave one job, if they were to ever to let you go, you could find another job pretty easily. That wasn't the case when I was laid off. It took me 3 months to get another job. And so only once I was there for a little bit and I saved up a little bit of money for a down payment along with my HELOC was I able to go and start with real estate investing?
Yeah, I mean, that's why I like asking that question, because I think it's really relatable that everybody who is a guest on this show or becomes a real estate investor that other people know doesn't mean that they were 3 years old walking properties like me. I was fortunate to have a dad who just liked to put me in the dirt and look at junk, but you can start at any time. And sometimes you start from something else that happens. But it's interesting, before that time that you got laid off, you had never thought when you were younger, like, hey, real estate looks cool.
No, and it's funny because my dad was in real estate a little bit. He had 6 apartments, just apartments, not 6 apartment buildings, just apartments, right? So, he was getting a little bit of cash flow from that. Good for him. It served the family well. And he always, said, hey, why don't you start? But I was a young kid. I was, in my 20s, and I was like, well, I don't know if I'm going to be in this one location for very long, right? As a young person, you can be pretty nomadic, right? You got a fresh degree. You can go anywhere, north, south, east, west, anywhere you want to go, international now, even more so than when I got my degrees. So he always, I don't want to say push, but he advised me to do something with that. And I never had an appreciation for it until I got laid off. And yeah, sometimes you need these inflection points to really, kind of wake you up to the fact of, hey, real estate isn't really all that bad. There's a lot of folks around to help. I know you help people, Jonathan. I help people, and, just these podcasts are free. And
exactly.
Right. Things I share with folks, these podcasts did not exist when you and I started. Right?
No, it was, people used to listen to like the tapes, Carlton Sheets or something else. And I could see myself.
Yeah.
I probably would have done it. I had my dad, so I didn't need the tapes because he ran on much longer than any tapes would every day about everything. But yeah, I mean, I think, having, like, what are you doing in the car? Do you want to listen to the radio where there's a commercial every 5 seconds? I listen to Audible or a podcast when I'm in the car. It's every single time, and I drive a lot. So if I'm on a 1 hour each way road trip, that's 2 hours of learning I can do while I'm just hanging out, relaxing. I think it's great. And the medium can help, help people just change their mindset a little bit.
Yeah. And so much of it is free, whether it's podcasts, whether even books on tape, super cheap, right?
Yeah.
Go get an Audible account, right? Super cheap.
Yeah, absolutely.
There's so much content out there to help people that's free or nearly free today. We didn't have that. And I think that's an important perspective to give folks, to say, you have such a tremendous opportunity today to learn from those who have come before you, who have made so many mistakes.
Yeah, exactly.
Who are eager and wanting to help others not make those mistakes, because they can be very costly.
I want to run this by you because it's something that might resonate with you. I found that the people who really understand that, and they're like, hey, this book is going to help me not step in the same pothole that somebody else did, they're going to succeed quicker. Then you have the other subset who's kind of built by ego, and they're like, well, I'm just going to do it myself. Real estate's like the last thing that you should try to do by yourself. Do you agree? Like you're going to do everything wrong.
I do. It's easier, it's cheaper, it's quicker to get where you want to be when you find somebody who's done what you want to do.
Exactly.
Right. Like I don't do Airbnb, right? I mean, I don't do short-term rental. That's just not what I'm in today, now. It's not that I, badmouth it or anything like that. Some people have really great models, and that's good. But, when I do coaching and we go down that road, it's like, hey, that's not what I do. But I have people in my world who are great at that. Right. So I don't pretend to help people in that way with Airbnbs. But I find somebody who's a rock star with Airbnb who is doing what they want to do. And I just match them up and say, go forward and be successful. Follow what this person did, and you too should be successful.
Yeah, but when you started, since we didn't have those things, how did you figure out what the heck you were doing in the beginning? It's like people are like, well, I read Rich Dad Poor Dad. There was like 3 books to choose from, that Millionaire Real Estate Investor and like one other one.
Yeah, honestly, it was trial by error. But
which I think is helpful. I do think that less people do it in people are maybe more risky now. I think like I like trial by error, even though I had my dad, but I just was smart about it. I wasn't like taking all of my money and putting it into a first deal. Like I don't even know what I'm doing.
Yeah, so I mean, I like to think, my mechanical engineering degree served me well because it gave me a very analytical
Yeah,
mindset.
you're a road
thinking
mapper. You
style.
want to know, you want to at least plan out what you hope is going to happen.
I was very logical with, hey, if I do this and I, do some risk mitigation along the way, I should be okay. And so that served me well. But yeah, it was pretty much trial and error approach. And, I do these podcasts and I get asked very often, like, okay, tell us about your first deal. What was the cap rate? What was the cash on cash? And all
Yeah.
these fancy terms. And it was like, let me tell you, I did not know any of that when I bought my
Me
first
neither. Yeah.
property, right? I was just focusing one metric. That's it. I want to know cash flow. I needed to do about $200 for each door that I was buying. So I bought a quad and I said, okay, I need to do $800 a month in cash flow. For me, that made sense. If I can spend some time and energy with this, I need to make at least $800 a month, right?
Yeah.
So that was my one and only metric. I mean, people were asking like, whoa, what's your cash on cash? And I'm like, I don't even know how to calculate cash on cash.
Yeah, I think on the larger scale, as we both know now where we are, like, of course, those numbers are helpful when you're talking about, 80 doors, 200 door type of properties. But like for people who are brand new, I use no metrics. I don't use spreadsheets. I've always called myself an asset hunter. I don't know if we talked about this, but I find myself always focused on the asset, and the asset means, what condition the building's in, where it is, what are the demographics of the area? Is that area going up? What do I personally like about the area? Am I going to want to go to this property to collect rent or do a renovation? And I think too many people these days are stuck in the spreadsheets. From your coaching experience, what do you think about that? Because it's so technologically easy to say that you're looking at 20 deals a week when you haven't even left your room. So you're not looking at anything because you haven't looked at a basement.
Yeah. And so with the coaching I do, I only do one-on-one coaching. And I think that's important. It's important for me. It's important for the person because everybody's different. Some people come with a very analytical mind and they almost need that spreadsheet to help them kind of make decisions to move forward. Other people, oh my God, you put a spreadsheet in front of them and they're paralyzed and they make no decisions. So it's, it's a case by case, based on the individual is what I feel is what I, kind of work with. Do we have a spreadsheet where we do some of those metrics? Sure we do, because some people are driven in that way and they want to see how the numbers work and compare to properties. Other people, they just, that just really, it's analysis paralysis for them.
Yeah, I just find that I love spreadsheets. I run half my life on them. I think they're super important for real estate investing in general. I just feel that the ability for people to, quote, crunch numbers is detracting them from going to see the property and being like, wait, this smells like a garbage dump. So no matter what the number says on the outside, the numbers look like it work, but that's not, accounting for the fact this smells like there's mold behind the walls. And I think that until you get those reps, as you go to your first property, oh, this looks great. It's a house with walls. This is awesome. And you're like, there's not even like the plumbing's obviously not working. Yeah. You're just like so excited. Have you seen that too? I think like for new investors, I always I want to help them not, step in the dumps, like we said.
Yeah, that's definitely an area where some folks can be paralyzed and not go out and see property. I think you're spot on. That is super important. You got to go out. You got to see what places look like, what basements look like, what tenants look like in terms of point. How they keep their apartment, because some people are super clean.
Do you want to deal with this?
Yeah, right. It's that reality check where you're like, do I really want to get into this? Wait a minute, I walked in and it just smells like, cat piss and, cigars. So it's like, do I really
That's a lethal combo, by the way.
do I want people doing this to my house? Do I really want to get into this business? So that's a very valid point. The other area where I see people become paralyzed is in writing offers. That's where the rubber hits the road. And it's almost like, oh my God, what if this offer falls in my court if they accept it? you know?
Great point. Great point. I've always said that I think more people they're much more scared of winning than they are of losing. They
Right?
win and they immediately crap their pants and they're like, why did I do this? You're like, we've been working for 6 months for you to get one accepted. Now you get one accepted and you want to cancel right away?
Yeah. So it's getting over that psychology of things. And I share with folks, right? So, sure, I have a technical degree, but I would have been better served in the real estate business doing what I do with a psychology degree than an engineering degree. And so that's a lot what I do with folks is work to get over those psychological hurdles, one of which is like, there's so many conversations I have with folks who say, oh, I could have bought that building 10 years ago. And so the question becomes not like, oh, how much money are you losing? I don't care about that. The question I ask, so why didn't you?
Right.
Right. Let's take some time because that's super valuable. Why didn't you buy it? What was your roadblock? Was it fear? Was it being uneducated? Was it you didn't have the right down payment? Let's investigate that because I don't want to go through a year with you if that roadblock is still there.
Yeah.
We've got to tear that down. So that's an interesting thing, the psychology of it. And folks get paralyzed with, writing an offer. And I say, the only way you're going to get over that is by writing offers, offers, and we help them build those offers so that they do have some exit strategies along the way. So it removes that fear of writing an offer.
Yeah. And I think people get into the habit of making lowball offers because they don't really want to win.
Yeah.
And then when they do win, then they're like, oh, well, something really must be wrong with it. Yeah. I mean, no shit. You're offering 100,000 below. Like, what do you, that's the point, and these are, I think it's really important that you brought up the psychological part because this is about the mindful approach to real estate investing. And like along the way, there was a year where I stopped doing real estate altogether for a year. I took a 36-week life coaching course, and that helped me so much. I already had experience as a negotiator, but as you said, the psychological aspects of working with clients, working with, coaching clients, and just dealing with people on the other side of transaction is really a big part of real estate. It's negotiation is one thing. You can read Never Split the Difference by Chris Voss, get some phenomenal tips. But each person, just as you were saying, each coaching client comes to you differently. Each person on the other side, seller, agent, they all negotiate differently. Yeah. And you have to know if they're fluffing or not, because that's where you're going to be able to figure out, where the best deal metrics are.
Yeah, and this is what goes back to what we were earlier speaking about is, seeking out those that have come before you, right? You and I, we can see these things in folks. Maybe it was, how we first started doing real estate, maybe wrong. Maybe it's through some of the other clients, right? We see this psychological dynamic playing out, whereas, it's kind of like we don't always see ourselves the same as other people see us. Yeah. I know there's many times where my girlfriend will give me the elbow and be like, you're being a jerk, right? And it's like, I think I'm being a great guy, right?
Yeah.
Like you're being a jerk, right? And so sometimes it takes another person to see things more clearly. And I think with a coach, with a mentor, with a buddy or somebody that's come before you, they might be able to see things more clearly in you than you see in yourself. Right.
Yeah. And I think that's where people miss on deals. Sometimes it's not even that self-analysis. It's that emotional attachment to something, whether it be, sometimes it's the emotional attachment to the FOMO of what we want to be. But in real estate, sometimes it's that emotional attachment to a property. Like you think this is the only one, where you don't want to sell because, your grandmother owned it, but somebody's offering you literally more money than you're ever going to see on this property in the next 5 years. And I think reducing that is a big part of effective coaching because if you're crying after you lose one offer, like it's going to be a long road.
Yeah.
Yeah. Go ahead.
No, to that point. I mean, because I think it plays all into this. One of the things I talk a lot about is, really positioning yourself to be on the edge of the coin. Not on heads, not on tails, but to be on the edge of the coin. Whereas if this happens, you win. If this happens, you win. In real estate, you can do that. Like I have somebody, looking to purchase one of my properties. And, I kind of look at it and I'm so unemotional about it because if I keep it, I cash flow. If I sell it, I 31 it into another deal. So it's like so unemotional for me. And so I think folks need to put themselves on the edge of that coin and say, hey, if I get this property, great, I'll cash flow. I'll have my first, second, third property. But if I don't get it, that's okay. I still have money in the bank to go live another day.
Yeah. Okay. And also I think you have to be able, like at this part, for you and I, people who've been in the game for a long time, there's lots of deals that I should have made and I would have crushed, but I'm not mad about it at all. I hope somebody else got a good deal. I'm just like, either, I did the numbers wrong or I made a mistake on that one. I'm not, perfect. So when I lose a deal and then I see it go well for someone else, I'm like, oh, good for them.
And that's another great point, Jonathan, is despite, and I want folks to really think about this because I think this is super important. Despite all the mistakes I made in real estate, and I made many, I'm super successful with real estate, right?
Yeah, it's not 100% game. I mean, it would be silly.
So, for the folks, again, watching, listening, to think about, can I make a mistake? Will I make a mistake? Yeah, you can and you will. And that's okay because this is a long game. This isn't, the short game. And that's okay if you make those mistakes because we all that have come before you probably have made the same or similar mistakes.
Yeah, probably the exact same ones, and then I think it's like we're trying to save you from making those mistakes. But if you make one, just try to make as small a mistake as possible. Don't leverage because you were talking about HELOC before for your first deal, and I see a lot of people looking to use HELOCs. Great idea right now because the rates are comparatively good, and people have earned so much equity since 2020 on their homes. But I see people say like, "Hey, I have $200K in equity in a HELOC. I'm going to use it all." I'm like, well, that seems risky because now you're just putting on a second loan and you're taking all of it. So like if I had 200K in equity, I'd see how can I use 50K and still maintain the 150K. Do you agree with that?
I do. And, all these things that we're going through here, I think it's super important, to get in the game, buy your first property, make the mistakes you're going to make, try to be risk adverse, obviously.
Yeah.
Like Jonathan is saying, if you have 100K, maybe only use 50, right? Because all these things that you're going to learn and experience, some are going to be super good, some are going to be super bad. All these things you're learning firsthand. And ultimately, what it does is it makes you become a better investor, not just for your second or third or fourth deal, but also should you want to take the leap into doing bigger deals like hundreds of units with a syndicator, right? Or becoming a syndicator or sponsor yourself to do bigger deals, right? Because to be able to go into some of those conference calls and some of those meetings as a limited partner in a syndication, it's better to have some experience with real estate than none, right? I mean, that's my perspective.
Yeah, I think you just know a little bit more about the overall process. Hey, it's Jonathan. On this brief interlude, I want to give you an update because our new website has launched. zenandtheartofrealestateinvesting.com is live and you can go there and check it out. I really want you to go check it out because we're going to still be upgrading more, but it's going pretty well so far. This is a very guest-focused podcast website. Each guest has their own profile with their own links to our 10-minute clips on YouTube, and also links to the episode. You can search for guests using the alphabet, or you can search in the search bar. Soon we're going to have tags up as well so that you can search in certain categories: short-term rentals, mid-term rentals, syndicators, multifamily, and then you'll be able to link to the episodes on that. I have really put a lot of time into working with my team to get this website to be extremely visitor-friendly and very guest-friendly. I hope you enjoy it. At zenandtheartofrealestateinvesting.com, let's get back to the show. We were saying before, the podcast and the books, there's so much that you can learn in advance that you can learn about syndications and not do them for 20 years, but at least you have a general idea like what the hell they are. So if somebody brings you an idea and you have extra cash and you feel like being a little bit more passive, then it becomes an option. And that's why you can just scroll through, episodes of podcasts and see like, hey, apartment buildings, I want to look at that. Self-storage, let me listen to that episode. You don't have to go in order. You can pick and choose what you want, grab a book and figure it out. But, as you were saying, coaching, I think, plays a really important role once people kind of get the ball rolling. I want to get your take on that because I've had a lot of coaches on recently as well. And we were saying like, hey, when's the best time for people to get a coach as a real estate investor? I've always said, I think it's a little bit better when they have the ball rolling and they want to get the momentum so they go over the top. Because if not, I think they're just trying to get motivation, which is also okay. But you're probably paying a lot just to get motivated. What do you think about that?
Yeah, I mean, so in general, right now, deals can be hard to come by, right? To have something that cash flows. I really want folks to cash flow on day one, and sometimes that can be difficult to do. So, during this difficult period that we're in, where everything seems to be overpriced and interest rates, and it's going to cost me more to get money out of my house or whatever it is, I just share with folks, just take a breath, use this time to get educated, right? If you've never done any real estate, like use this time to get educated, make some connections, create your circle, your network, right? And just learn. Just slow down. Like, don't have anxiety over this, right? You don't have to buy anything today, but let's use this as an opportunity to, just learn. And maybe we pick a couple of properties off of MLS, for example, and just let's run some numbers. Let's, to your point, go see those properties. Yeah. Not that we're going to buy them, but let's just get some boots on the ground and let's just go see 5 different properties today, just to get a feel for that environment, what tenants are like, what the building is like, what are some scary things I might encounter, and just overcome some of that stuff. So that's one of the things during this time where it can be difficult. Just use this time to kind of take a pause, get some education, put some boots on the ground, go see some properties, and see if this is really what you want to do.
Yeah, a couple things on that. I mean, I think first, I've been saying a lot recently, it goes right into what you were saying. Taking action isn't always buying. Yeah. Taking action, like you said, is getting in the game, making sure you're going to meetups, talking to other investors, learning what they did, and moving forward. You're moving the ball forward. It doesn't mean you have to buy. The market, there's a low inventory. There's not a lot of good deals. So just save your money, like park it in index funds for now. You don't have to hit a home run every year. But you want to be moving forward, or else if you just sit around and wait for the deal, you're not going to know anything when the deal comes. Yeah. And then, as you're saying, you're going to go look and you're not really even going to know what you're looking at.
And I'm going to give I'll give an example. Not that we planned this conversation this way, but it just kind of organically goes there, right? Because I like to talk by example about my own experiences. And so what we're talking about, getting educated and kind of getting out there, works on so many different levels, right? So I'm out there, I'm looking, honest to God, I don't really see a whole heck of a lot. But you know what?
I can't find anything for myself, and that's fine.
Right? But we have such great relationships. We have such a great network after doing this for 20 years that we've partnered with somebody else who has great deal flow, right? And so through that great deal flow, they have great deal flow. I have great property management experience, and another guy has great ability to raise money, right? So between the three of us, we're like unstoppable. So we just closed on a property, 153 apartments down in Florida. Great market, great value add, and we're going to knock it out of the park with that. But the reason why I bring it up is not as a promo pitch. It's as a, use this time to create your network, because had I not been doing that all along the way, I wouldn't be in this position to be able to partner with others, right? I mean, I wasn't looking like when, a few years back when I was creating these relationships, I was just like you and I, we're just talking. We're just, trying to help others out there, and we're just doing our own thing. It wasn't like, hey, Jonathan, let's get in on a deal together and partner. No, it wasn't like that. It was just, we were just creating a relationship. And I knew these are people that I maybe one day can partner with because I resonate with them in a lot of different ways. So you never know when those opportunities are going to come along. But, for somebody who's just starting out, I can totally envision, somebody who is a great contractor, who knows how to do roofs, do floors, do all that sort of stuff. He can find a great fixer-upper, turn it into a rental or maybe add an ADU to it, an accessory dwelling unit, do all these great things. But they may be strapped for cash. You think that might be a good opportunity to maybe create a partnership with that individual if you know them, right? If you, again, you got to vet out those partnerships. But if you're bringing cash and that other person is bringing the know-how, the skill, that might be a great 50-50 partnership.
Yeah. Yeah, I agree. I mean, joint ventures, I think I've always said if you go to a meetup or do the same thing in real estate investing for 6 months, whether it's a weekly or a monthly thing, deals and mentors will all appear. Yeah. Just because you don't walk in with an ask. If you walk in and say, hey, who wants to JV? Or sometimes I see posts where somebody are like posting in literally an open internet forum, hey, I have $250K to spend. What should I do? And then it's just, all you're going to get is pitched. You're going to have your DMs full of pitches from people who have no experience. Like that's not the energy that you want to bring. Then you have to leaf through stuff that you're going to think it all sounds great. Probably going to lose that money. If you just went to a meetup, didn't tell anybody that you have $250K to burn, worked at it, and then somebody one day, as you said, say, hey, I have a deal, I can't close it myself. I'm looking for partners if you know anyone. And then you're like, oh, actually, I might be interested. And then you go take a look and decide, and take a look, meaning in person, go look at more properties.
Yeah. And that's, you had shared something there that I just want to really dive a little bit deeper into is, if you're an individual, know your value, right? Don't come with an ask, right? Yeah. Don't come to me and say, hey, Tony, do you have $1 million I can borrow? I don't want to hear that, right? Nobody wants that, right? Don't.
And ask. Can I take you to coffee for 15 minutes? No, thanks.
Exactly, right? It's, don't come with that ask, bring something, right? And there's so many syndicators, sponsors, partners that will say that, right? Bring me a property. Maybe you can't afford the down payment, or maybe you can't work. But bring me a deal. Show me that you ran the numbers and this works. You just need a little bit of help with the down payment. Okay, bring me something. Don't just come with an ask. Understand the value you're bringing to the party.
Yeah, no, I think that's important. You want a win-win situation, everything. And for people with more experience, you have to have something to bring to the table because we have other relationships that are already ongoing. Yeah. Going back though on your history, how did you go from that first fourplex to where you are now? What type of properties were in the middle for you, and which did you like, which didn't you like as part of that process?
Well, that's a great question. I'm glad you asked it, especially again, for folks who are brand new or somewhat new, maybe already have their first or second property. I didn't get where I was by buying $1 million properties or hundreds of doors at a time. That's not how it happened. Yeah. It happened slowly. I bought a 4-unit building. Then I bought a 3-unit building. I think I bought a duplex. Then I bought a 5-unit. And, so I bought small buildings. These weren't multi-million dollars. This is what I could do. But they were all in my local area for the most part. So I started small. And I encourage folks to start small. There's nothing wrong with that. So I encourage that. And that alone, just doing that, just having those small properties allowed me to retire at the ripe old age of 44.
Yeah.
Right? So it didn't require a lot of, I didn't partner with anybody. I didn't do a syndication. I didn't JV. I didn't do any of that. This was just me kind of coming along and picking up properties along the way. So I encourage folks to, maybe look at what they want and kind of go after that. I do have a lot of folks who try to follow my dream and my success. And I share with them, and if that's what you want truly, then great, go after that. But understand what your dream is, your success. If you're I was, 30 and 40 years old doing that, and that worked well for my time frame. If you're 50 or 60 years old, that model may not work for you.
Yeah.
So make sure you're following your dream to whatever success you want to reach. So, so I started, that's how I started. That's how I got to my, my financial freedom, my life of freedom. I retired at the age of 44. I was doing all great things. Like I'm a big hiker, biker. I like nature. I like to travel, all that. So I was doing all that stuff at the age of 44, plenty of cash flow, living a dream. But I was looking to my right and my left, and all of my friends were still working. And I'm like, this kind of sucks.
Yeah. No one wants to go for a bike ride.
Yeah. Everybody was busy.
Yeah.
And so I really ended up taking a deep dive. I have a passion for economics. And so I really started taking a look at all things macroeconomics. Because I was having a lot of conversations with folks, and they were saying, oh, the politicians, they're bad, they're screwing things up. Everything was like somebody else's problem, like politicians. And, so I'm like, no, that's somewhat true. Politicians are part of the problem, but there's so much more to that. So, I started sharing and educating, that, hey, these problems aren't just a result of the politician. It's the education system that's poor. It's the society itself doesn't help themselves. You got to put some of the blame on yourself, right? It starts at home. If you want a better environment, it starts at home. Teach your kids, teach yourself. Instead of sitting on the couch like a log, maybe pick up a book, watch a educational podcast, right? These things all start at home. The politicians aren't preventing you from doing that stuff, right? So society itself doesn't help themselves. The monetary system is broken. It's been broken for a long time. It'll continue to be broken. And for folks that realize that, they're protecting themselves. Right. So there's a lot of different things that I've, come to know. And so I ended up writing the book, Freedom at Risk, How to Protect Your Personal and Financial Freedoms, which was, as much of something I needed to do for myself, but also I wanted to get it out to the world to really show folks how our freedoms are at risk. So there's a lot of, great ideas in there, like a la carte, like, hey, if real estate resonates with you, go do real estate to build a life of freedom. If it's something else, I talk about asymmetric plays on different things. Bitcoin used to be an asymmetric play where you could buy it for like a nickel.
Right.
For very low money. And if it went up, which it did, you made millions, right? So that's an example of an asymmetric play that happened in the past. So there's different things like that. So folks can kind of pick and choose whatever resonates with them. But through that exercise, and that took me about 5 years to get through writing that book, publishing that book, because it's very detailed. But I started to realize I'm better positioned with partnerships to do real estate today. I'm better positioned to do partnerships because of that experience of doing this deep dive in macroeconomics.
Yeah.
And I can serve people better because I'm a better investor, right? So when we do invest, there's a reason why we're in Florida, right? I see folks operating in some other states, and that's fine. I saw somebody who just posted, to your point, you see things on Facebook. I saw somebody posting, hey, I'm looking for a property in New York. And I'm like, why would you ever want to invest in New York? Like, run from New York.
I sold everything in New York over the last 3 years, and I made out great. And we had properties that were so old. I'm like, I'm good. I've spent the time.
I don't mean to offend anybody, but New York just isn't a landlord-friendly state. People aren't really migrating to a great degree to New York. So we love Florida. Why? Because we look at the macroeconomics of Florida, right?
Yeah.
We look at, almost 1,200 people a day are moving into Florida. Yeah. That's people we want to serve, right? We want to serve people who are moving in with great apartments. We want to help them with that. But then we also want to serve our investors to be making those good decisions to say, we're in Florida for a reason. It's not just, we want to make cash flow. It goes beyond that. And I see so many syndicators who are like, hey, we want to make cash flow. Okay, let's dig deeper. What's the next level? Like, why Michigan? Why Wyoming? Why California? Like, tell me why you want to invest in those areas. What's the macro behind it? We can talk to that. Some others can't.
Yeah, I agree with that. I think there's a lot that it's a price point. They're like, oh, no, I really love this random area in the Midwest, which there's great investments there without any question. But sometimes it's just matching the price point that somebody has available, for themselves. But yeah, I mean, Florida's a never ending cycle of retirees going down there because of the weather. Same with Arizona. Like those areas are just going to keep producing. It's just that Arizona keeps going up crazily. Florida is in a great spot right now because a lot of the areas are allegedly trending downward, which makes for better purchases. The insurance premiums that went up are a little bit better now on large scale. They're still higher than we would have liked, but that's all built into the equation that sellers understand finally now. Like, hey, you're not getting that money. You're going to have to account for that.
Yeah. Yeah, absolutely. Times have changed, and that's okay, right? Interest rates aren't 3% anymore. The insurance cost isn't, $300 a door anymore, right? Things are more expensive, and you just got to match that with the market and make sure the market can absorb that cost, right? What I'm seeing today, I'm seeing syndicators, people that I know in the space, who they went in and they were saying, hey, we're doing a value add. We're going to make an extra $200 a door and all our LPs are going to be, happy. What's actually happened over the last year or two, they did all this great value add, but that extra $200 a door that they're getting is going to pay for insurance.
Yeah.
Premiums that have gone up, is going to pay for property taxes that have gone up, right? These costs have gone up. So it's great. They're making $200 more a door. They fulfill that, but that isn't going to the LPs. That's going to sustain the property. And a lot of folks didn't see that coming. And they're ill positioned for that.
Yeah, I mean, I think there's a lot of apartment opportunities out there that people are still holding too tight onto because they know they kind of messed it up. They don't want to ditch it at some type of a loss or even a break even. But it's just a part of what happened with the rates, and people were on floating debt and different things that they, again, didn't foresee. As an investor, I've always tended to be a little careful. My dad kind of taught me. My dad was into educated risk. But educated means the more education you have, the more you can take that type of risk. For somebody to take an educated risk when they don't know a lot is usually banking on somebody else's, allegations of what it really is. And that's what we're talking about. These syndications that are in trouble or having capital calls, they were banking on the wrong metrics, which means you're banking on the wrong operator if they weren't ahead of the curve on this, right?
Absolutely. And so there's a couple of things here. We look at, the term distressed is thrown around quite a bit. We make the distinction when we're looking at properties, whether it's actually a distressed property that, 50% of the roof needs to be replaced,
right,
and, the actual property is distressed in some way, versus the property may be fine, but it's actually the operator distressed, right?
Yeah, so, physical versus economic distress.
Yeah, so we look at those different types of distress to find the best deals out there. And so I think for folks who have properties or are looking at properties, that's a good way to look at maybe yourself. If you didn't see things coming, how am I distressed right now? If you have a property or two and you're like feeling pinched right now, like really look at it and say, is it really and you got to be honest with yourself. Is it the property that's distressed, or am I distressed in some way? Right. And so, if you're more experienced, maybe that's some food for thought. If you're looking to sell or buy, maybe that's food for thought. But also for some of the less experienced people who haven't done their first deal, or maybe they have one or two properties underneath them, maybe something to look at to avoid distress or to understand distress better is using a private money lender. And I talk about this sometimes, and folks are like, "Oh, I don't want to use hard money or a private money lender. Those are bad people, and they're going to charge me, 10% and 12% fee." Okay, but that private money lender, let me tell you, they have a wealth of experience behind them, a wealth of knowledge. And sometimes that's something you have to pay up for, even if it's for a year or two of using their money. You know, don't be afraid. If the numbers work at 10 and 12% for private money, you know, you're going to get, over that first year or two, you're going to get a ton of education from that private money lender. And the other thing you're going to get is that private money lender, if you're looking to scale your rental portfolio, that private money lender is not going to lend you money if that property doesn't perform.
Yeah, especially now. Yeah.
Right? Wouldn't you want to learn that up front? And isn't that very valuable to know up front? Even if you're going to pay 10 or 12% for that money, it's going
to be a pretty good deal if they're going to green light it now overall. I think going back to something you said before, when somebody's looking at it, that there's, you know, a good outcome and a different good outcome. I think if people are looking at properties that they feel are kind of, you know, a weight around their neck now, you have to look at it and really decide. I've always said, like, sometimes a couple flips that I did in my life just didn't go that well. Partners either flaked out or I got a red card from the city. So I ended up selling at like almost a break even. I very rarely have lost on a flip, but then I got the deposit money back. You know, I had 20% down or 25% down. So it's like, did I really lose anything? I'm getting money back to go deploy into something else. And I finished the project. Project looked great. Just some weird anomalies of timing and stuff, you know, pandemic threw a monkey wrench in it. And that's where it is, you know, the mindset of an investor. Do you want to cry into your bowl of Cheerios, or do you want to say, like, I took that one on the chin, but hey, now I have some money back. Let me do better on the next one. Use what I learned on this to not do that same thing again.
Yeah, I mean, I'm giggling because, you know, investors, the more you're in this realm, you realize investors are never happy.
That's a good point.
Right? And you're laughing because you get it, Jonathan, right? You know, oh, interest rates are high. The cost of money is high. It's expensive. You know, I'm not happy. But look at what was happening when the cost of money was like 2 and 3%. Oh, the price of homes are high. You know, I don't want to pay these elevated prices. I'm not happy. Right.
Right. So, it's 3%, but now I have to, for just some junk house, I have to bid against 40 other people. So choose your poison. That you were talking about that something in this area before. And I think it's important to really just, when you're staying in the game, then you're not losing on that part. Like, we can't control the things that are happening outside. You know, you're talking about macroeconomic factors and politics. Those are good to know about, but I can't control any of that. So my job is to allow all those things to happen and figure out how to pivot, because then I'm way ahead of everybody else who's in the debate about, hey, are the politicians screwing over the economy? I mean, yes. I mean, but I can't stop them. What am I going to do? Call someone? Like, I can't do anything.
Yeah. And that's, you know, you're so right. You know, we cannot control the macro of things, right? I can't control whether there's going to be a recession or not in the next year. I can't. And there's so much doom and gloom out there that you become fearful for these things.
It's just like a news cycle, you know,
right?
Everything. I mean, it's like that's the news, though. The news is never like, hey, things are going to be great. No, it's always shit. You know, every single thing. It's all garbage.
But if you've been listening to, and not to throw them under the bus, I respect them, and I know a lot of people do, but a lot of people know that Robert Kiyosaki has been sharing doom and gloom. The real estate market is going to crash over the last 15 years. And if you were not, right? And if you listened to that advice, I mean, you'd still be poor today, right?
Yeah.
So you got to be careful of where it's coming from and what they're talking about. We look at macro, and we're not all like, we're not excited about some of those negative things, like maybe a recession is going to happen. But that's one of the reasons why we play in Florida, because we look at it and we say, to your point, there's so many retirees that are moving to Florida. When a recession hits, like, they're going to be more immune to a recession, because those retirees, those folks, have a solid pension that's still paying them out, or have solid Social Security that's still paying them out, or some combination, so that they're still going to restaurants. They're still going to the stores, right? Those service jobs and those middle-class jobs, they're still going to be available to the majority. The impact of a recession is going to be much less in Florida than in some other states.
Yeah, and I mean, if you just look at, so I was moving from Florida to New York in 2008, so I got crushed on two properties because I had them listed when I was trying to move, and then the market tanked. But like Florida did go through, allegedly a real estate disaster in 2008 and 2009. Not for the investors who had money to buy, though. And if you just held those properties, if you weren't over leveraged and you held those properties, you'd be up, 200% now. So real estate is, buy real estate and wait, not wait to buy real estate. So if you're thinking long term, sometimes you do have to ditch a property. Life brings you something and you have to do it. But that's why it's cool to have assets that you can trade, especially like when you were saying when you had, a 3, a 4, a 2, you look at them all and say, well, I have to get rid of one. Which one's like underperforming or which one is performing the best? So I'm going to get the most money for it so I can then get, double the units out of it. And I think that's just a part of investing and trading. You have options to figure out what you can do as you go, as you diversify your portfolio and see, if they're in different markets too, you're like, well, which market's going to get better rents? Rents going down one area, let's jettison that one. That's what the fun part about it.
It gives you that. You're so right. It gives you that opportunity. And I don't know what other field gives you that.
Yeah.
We have a client now that's purchasing a duplex, and we're having such amazing conversations because he's talking about all these different things he can do and and I'm like, that's right, because real estate provides you that opportunity to do it. If you didn't have this property, your opportunities would be virtually none. But because you have this property, this rental, you can go off and start exploring some of these other things. And it's so cool that it provides that. And sometimes it takes people to actually be in the game to actually see that door open for them.
Yeah. So, I mean, if you're listening now, this is just a reminder to get in the game. And that doesn't mean buy, just get your head in the game, start meeting other investors. Tony, this was a great episode. Is the best place for people to find out more about you and what you do at dirtybootscapital.com?
That's the best place for them to go. And if they want to reach out, I encourage them, shoot me an email. My email address is Tony Lopes with an S, Lopes, Tony Lopes at dirtybootscapital.com.
Where'd you come up with the name? I was before the podcast. I'm like, I know there's a story. Like, let's hear it. What did the Dirty Boots stand for?
So, like I had shared, my dad was in the business to a degree. So he physically got his boots dirty, doing property turns and maintenance and all that sort of stuff. And that's kind of how I got in. I did a lot of property management stuff myself with my own properties. I got my boots dirty, renovating a lot of stuff. I bought buildings that were horrible, right? Leaky roofs, hole in roofs, down to the studs. That's how I got started. I got my boots dirty. But today, we share it from a broader perspective. Getting your boots dirty on the ground, doing some of those repairs and turns, it can be important and is definitely an experience to have.
Yeah.
But getting your boots dirty means so much more to me today. Based on my 20 years of experience, it's getting your boots dirty, walking through T12 financial reports.
Yeah.
Right. Getting deep down dirty, walking through those reports, walking through migration patterns, what's happening there, right? Really getting deep into that, looking at demographics, what's happening with the 5 to 10-year-old demographic, right? And I don't share that to be like 5 to 10 year. Those are our future renters. Where is that population? Like I look in some areas where people are buying properties to a great deal, and I'm like, your 5 to 10-year-old category, your future renters is diminishing each and every year. Like those are your future renters. So like in 10 years, are you going to be hurting for renters? I don't know, but so we look at a lot of these different reports to get our boots dirty, to make the best decisions we can for ourselves and for investors. So that's where Dirty Boots comes from.
Yeah, I love it. I'm glad I asked. And it's just get the reps. You got to get the boots dirty by getting the reps, seeing properties, like you said, doing the stuff that's going to be vetting deals in concert with real life is really the way to get a well-rounded approach. Awesome, man. I'm glad we did this the other way. Thanks for spending the time with me. I really appreciate it.
This has been great. A lot of fun with you here, Jonathan. Thank you so much for having me on.
Yeah, man. Appreciate it. All right. That was Tony Lopes of Dirty Boots Capital. I'm Jonathan Green. We'll see you next episode.
Thanks so much for listening to another episode of Zen and the Art of Real Estate Investing. And if you listened to this part last week, you now know that I'm dropping previews of the next episode here at the end of each episode. So as each episode ends, you're going to get a preview of who's up next in the lineup. And next week for episode 159, it's Brian Davis, the co-founder of Spark Rental. We go all over the map on real estate investing because he works not a syndication, but a real estate investing club. This is very unique, and it gives the opportunity for people who are not accredited investors to invest together with friends, colleagues, and learn along the way. I know you're going to love that episode, so stay tuned for Brian Davis next episode. Thanks for listening.